During current market condition, we have seen a shift from tech growth stocks to more value stocks or dividend stocks. While we are seeing high inflation, increase in interest rates coming up, and war, investors tend to try to find a less risky and less volatile market to invest in order to avoid big losses. Hello everyone, welcome back to the channel. Today we are going to talk about 4 dividend stocks. If you're new to my channel, welcome. Please consider subscribing and smashing the like button since it really helps the channel out. And also go get 5 free stocks with Webull when you open an account with them and deposit any amount of money. It does not have to be $100, it could be $10. Now, dividend investing is a method of wealth accumulation that offers inflation protection in a way that other investments such as bonds do not. But what should we focus on when investing in dividend stocks? Dividend investors should see companies with long-term profitability and earnings growth expectations of about 5 to 10%. Remember that dividend-paying companies are not expected to have a huge growth year over year, as they are not growth and innovation stocks. Dividend-paying companies tend to be mature companies that make a lot of money, and they think that the best way to give back to their shareholders is by paying dividends instead of maybe reinvesting into their business. Because companies that make a lot of money, have tons of profit, have several options with that money. Option number 1 is to do buybacks, which also benefits shareholders as they decrease the number of shares in the pool, and in the long term it helps the stocks to continue rising. Apple does that a lot, for example. Option number 2 is reinvest those profits into their business to continue innovating for new products, new services they might have in mind, to continue expanding and seeing more growth as a company. The other option is to pay dividends to shareholders. Another important aspect we should focus on when finding good dividend stock is that we should avoid companies with debt to equity ratios higher than 2, as it means that companies are relying more in debt than equity generated by shareholders. First dividend stock I want to talk about is a stock that I used to invest in 2019. I'll post a picture here or here, but sold it in 2020 as I rebalanced part of my portfolio and focus on more growth stocks. But have to say that this is a company that has always thought it was a nice investment, and this is Waste Management. As its name says it, they are a waste management company for residential, commercial, industrial, and municipal customers in North America. I would assume that you have at least seen their trucks that they use to pick up and transport waste and any recyclable material from where it was generated. This stock is currently trading $155 per share with a market cap of $64.56 billion, a PE ratio of 36, a little bit high, but with earnings per share of $4.26. I do have to say that it is not a huge dividend paying company in comparison to other companies, but they pay a dividend of 1.67%. It has a return on equity of 24.92%, profit margin of 10.13%, and a total revenue of $70.9 billion. Their balance sheet is something they have to work a little bit on, but they have $118 million in cash and current ratio of 0.75, with a nice growth expectations of 6.20 and 5.20% in 2022 and 2023 respectively. This is a company that, in my opinion, is a good holding, even more with the possible slower economic growth this year, as it is a type of company that no matter what crisis we are in, people will need to continue paying for waste management, just like they do with food at Walmart, for example. Next dividend stock I want to talk about is in the financial sector, and this is JP Morgan, a very popular one. And although I have always voted more for Wells Fargo than JP Morgan or any other bank between the biggest ones, I believe that JP Morgan is an excellent as well and has a better dividend yield. Remember that we are focusing on these companies as dividend investors and not as growth investors. At the moment in 2020, I preferred Wells Fargo over JP Morgan or any other bank, as I saw more growth potential in Wells Fargo in the short term, which is what happened with their stock. But today, I want to talk about JP Morgan. It is currently trading at $140.45 per share with a market cap of $414.29 billion and a PE ratio of 9.14 and a nice earnings per share of $15.36 with a 52-week low of 127 and a 52-week high of $172 per share. Now, JP Morgan currently has a nice profit margin of 36.92%, return on equity of 16.86%. The stock is currently down 9.69% in the past year and up about 60.50% in the past 5 years. As we can see, the stock is almost at the same price it was before the pandemic. Analysts are expecting JP Morgan to not report a growth this year, but 6.30% next year. They currently pay a dividend of 2.85% with a nice dividend payout ratio of 26%. Now, the next company we are gonna look at is a very popular one as well and called Starbucks. The stock is down almost 29% since its peak. I assume this company does not need any presentation, as I assume all of you already know what they sell, and if not, where have you been? Now, jokes aside, Starbucks is currently trading at $89 per share with a market cap of $103 billion and a PE ratio of 24.21 and earnings per share of $3.70 with a 52-week low of $79 and a 52-week high of $126.32. It reported a total revenue of $30.36 billion with a nice year-over-year growth of 19%. It has a profit margin of 14.45% and total cash of $4.06 billion. Analysts are expecting them to report a growth of 12.80% and 9% for 2022 and 2023 respectively, and currently have a dividend yield of 2.24% with a payout ratio of 53%, which we can see is a dividend that has been growing a lot since 2016. Now, Starbucks is, in my opinion, a high quality company that is going in the right direction and has a nice and attractive addressable market. Even though their coffee might be a little bit expensive, as many say, the growth they have had over years has been pretty nice, as well as their expansion, and I don't expect that to slow down anytime soon. Obviously, if we were to see a recession in the country, they will be affected, but I believe it is a nice dividend paying company for the long term. Last but not least, we have Verizon, which is a company that I used to use their service before, and I have to say that is, in my opinion, one of the best ones out there. Right now, I switched to T-Mobile mainly because I moved to Venezuela and T-Mobile has the free roaming plan, while Verizon was way more expensive as I don't live in the US anymore. But when I used to have Verizon, it was very nice. They offer a really nice service. Even though we know investors have been concerned about the cost of building out wireless networks, the company's core wireless business is very profitable and growing steadily. Also, we know that 5G gives Verizon a nice long-term potential. As many of you like to talk about EVs in this channel and autonomous driving could have a tremendous value as it spreads across the country. Verizon currently has a dividend yield of 4.89%, which is really high, with a payout ratio of 48% at this moment. I do have to say that I am not a dividend investor. I focus more on growth and technology and innovation and disruptive companies and more. I invest in some dividend paying companies, but not because of their dividend, but mainly because of the company, the growth, and what I like about them. But they still pay dividend, such as Apple or Microsoft, for example, or even Visa. But after doing research for this video, I think I might start another pie on my M1 Finance portfolio, which is the one that I use here to do experiments with you guys, with a dividend stock pie, as there are a lot of companies with nice potential and nice dividend. If you have any recommendations for that, let me know in the comment section below, and also let me know if you invest in any dividend stocks or not, and why, or what kind of investors are you. I'll leave you here a video recommended by YouTube and here as bottom for you to subscribe. Thank you and see you next time.